Welcome to today's news impacting the markets. President Donald Trump is planning to issue an executive order that will allow cryptocurrencies to be included in U.S. retirement plans, according to a report published Thursday. The executive order is expected to be signed this week, the Financial Times reported, citing three sources familiar with Trump's plans, allowing 401k plans to diversify their investments beyond traditional stocks and bonds. The proposed investments span a wide range of asset classes, including digital assets, metals, and funds focused on corporate takeovers, private loans, and infrastructure deals. The executive order will instruct regulatory agencies to identify and address the remaining barriers that prevent such alternative investments from being included in professionally managed funds used by 401k savers. This report follows the Labor Department's decision in May to lift restrictions that previously discouraged the inclusion of cryptocurrencies such as Bitcoin and Ethereum in 401k retirement plans. The department rescinded a Biden-era guidance that had urged plan fiduciaries to exercise extreme care before adding cryptocurrency to investment menus, going back to its historically neutral position on such investments. The Wall Street Journal, meanwhile, also reported that Trump was preparing to sign an executive order allowing for private equity investments in 401k plans. A 401k is a retirement savings plan sponsored by an employer that allows employees to save and invest a portion of their salary before taxes are taken out. Americans held $12.2 trillion in all employer-based DC retirement plans on March 31st, of which $8.7 trillion was held in 401k plans, according to the Investment Company Institute. In other news, Federal Reserve Governor Christopher Waller just made the case for cutting interest rates at the Federal Open Market Committee's July meeting. On Thursday, speaking at the Money Marketeers of New York University, Waller said, "I believe that the Federal Open Market Committee, FOMC, should reduce our policy rate by 25 basis points at our next meeting." End quote. Waller pointed to a string of recent economic data to make his case, saying, quote, "Real gross domestic product growth was likely around 1% in the first half of this year and is expected to remain soft for the rest of 2025, end quote. He also believes consumer spending is expected to continue to grow at a similar pace, tempered by the expected slowing in growth of real disposable income, while framing labor market trends as a particular concern since he said, quote, "Private payroll employment grew just 74,000, a much smaller gain than in the previous 2 months," end quote. He says job growth is, quote, "much closer to zero," end quote, describing private sector payrolls as near stall speed and flashing red, highlighting the need for the Fed's intervention. On inflation, Waller believes the recent increases tied to import tariffs should not influence the central bank's policy. He says, quote, "Tariffs have boosted and will continue to boost inflation a bit above FOMC's 2% objective this year, but policy should look through tariff effects and focus on underlying inflation," end quote. Summing up his stance, Waller said, quote, "The evidence of a slowing economy and all the factors I have cited weighing on economic activity mean that the risk to the FOMC's employment mandate are greater and sufficient to warrant an adjustment in the stance of monetary policy," end quote. Consumer spending, however, continues to remain strong, with U.S. retail sales jumping 0.6% in June, ending a 2-month losing streak in the face of tariffs, trade tensions, and geopolitical uncertainties. This weakens the case for a rate cut amid growing pressure on Fed Chair Jerome Powell by President Donald Trump in this regard. Powell has repeatedly said that it was Trump's tariffs that deterred the Fed from easing its monetary policies. In other news, the combined market capitalization of America's 7 largest corporations have now overtaken the entire economic output of China, the world's second largest economy. As of July 17th, Nvidia, Microsoft, Apple, Amazon.com, Alphabet, Meta Platforms, and Broadcom together reached a staggering $18.84 trillion in market value. That figure now exceeds China's 2024 gross domestic product, which stood at 134.9 trillion yen, or roughly 18.7 trillion when converted at current exchange rates. This valuation supremacy is fueled by a concentrated wave of investor enthusiasm around artificial intelligence and future cash flow generation. Nvidia alone now holds over $4.2 trillion in market cap, riding a 2024 rally powered by GPU dominance in AI workloads. Yet, while the headline comparison is striking, it's important to recognize that market capitalization and GDP measure entirely different things. One is the total value of a company's stock at a moment in time, the other tracks an entire country's economic output over a year. One is a stock, the other a flow, so the comparison, while headline-worthy, is not economically sound. Still, the fact that just 7 US companies are now worth more than China's entire economy says a lot about how much confidence investors have in America tech. While comparing Wall Street's Big 7 to China's entire GDP generates headlines, a fairer and more financially sound comparison pits the largest US companies against the largest Chinese companies by market cap. The result is still striking. As of July 17th, the combined market capitalization of China's 7 biggest publicly traded firms stood at just $2.3 trillion, or 12% of the $18.84 trillion total commanded by the US tech giants. By comparison, Nvidia alone has a market cap of $4.2 trillion, nearly double the value of China's top 7 combined. In other news, a global build-out of data center infrastructure is charging ahead to meet the immense computing power needed for AI ambitions by tech giants like Meta Platforms, Palantir, Amazon.com, and others. Goldman Sachs now expects global data center demand to soar 50% by 2027, setting the stage for a massive expansion in power generation and infrastructure investment across the AI value chain. In a note shared this week, the firm analyst James Schneider projected that global data center demand will jump from 62 gigawatts in the second half of 2025 to 92 gigawatts by 2027, a 50% increase in just over 2 years. AI workloads are expected to drive that growth, expanding their share of total demand from 13% to 28% by 2027, while traditional workloads shrink to 21%. Overall, Goldman expects global data center power demand to rise 165% by 2030. A shift so large that, if isolated, it would place data centers among the world's top 10 electricity consumers. The question to ask is, can supply keep up? The power constraints are looming. In the US, where data centers already consume 4% of electricity, Goldman forecasts that share could more than double by the end of the decade. Meeting that power need will require 72 gigawatts of new generation capacity, with 25 to 30% likely coming from solar and 30% each from combined cycle and peaker natural gas plants. Adding momentum to the data center arms race, Meta CEO Mark Zuckerberg recently posted on Threads that the company is building 2 multi-gigawatt AI clusters. Bank of America analyst Justin Post said the statement, quote, signals to the street that the AI capex cycle is far from over, end quote. Post raised his 2026 Meta capex estimate by $6 billion and now expects $229 billion in total capex spend from 2025 to 2027. According to Goldman, data center operators such as Digital Realty Trust and Equinix are positioned to sustain profitability above historical levels. The tight supply-demand balance also benefits infrastructure and industrial players. Cummins now sees 35% of its power generation sales linked to data centers, while Caterpillar generates about $2.8 billion annually from the segment. Together, they're projected to supply 6 to 7 gigawatts in backup generator capacity this year. Jabil raised its fiscal 2025 AI-related revenue forecast to $8.5 billion, up from $7.5 billion in the prior quarter, citing strong demand and near-peak utilization at some factories. The Donald Trump administration is reportedly preparing a sweeping executive order aimed at curbing perceived liberal bias in artificial intelligence models used by government contractors. The White House plans to require AI companies receiving federal contracts to ensure their models are politically neutral, reported the Wall Street Journal, citing people familiar with the matter. The upcoming executive order is part of a broader agenda led by Trump's top tech advisors, David Sachs and Sriram Krishnan, both of whom have raised concerns about woke outputs from popular AI systems. The order targets what administration officials view as left-leaning bias in AI-generated content, including controversial depictions of historical figures and politically charged responses to prompts. For instance, Alphabet's Google Gemini model previously came under fire for generating racially diverse images of Nazis and depicting George Washington as black. The executive order would apply to any AI firm seeking federal contracts, potentially forcing major tech players to adjust how they train and fine-tune their large language models. Political neutrality could become a requirement for AI used in federal agencies, marking a significant regulatory shift, the report said. This order is expected to be part of a broader AI initiative from the Trump administration, which includes promoting U.S. chip exports, streamlining data center permitting, and expanding energy production to support AI infrastructure. With major firms like Microsoft, Google, Anthropic, and Elon Musk's xAI vying for government AI contracts, the executive order could have a profound impact on how models are developed and deployed. While it may appeal to conservative critics of woke AI, it's likely to raise alarms across Silicon Valley, where developers warn that political constraints could hamper innovation. And that's been your daily news impacting the markets. Be sure to subscribe and follow Benzinga Daily to stay up to date.